After some improvement earlier in the week, the mortgage bond market's ending the week a little worse off, at least for the moment. And the main reason wasn't really anything specific to the US economy. Global bond yields have jumped a bit, and when that happens, our yields usually move higher too. The global economy is connected, but that's kind of what pushed mortgage-backed securities in the wrong direction this morning. The good news is the bigger housing picture does still look healthy. A survey at Top Economist shows expectations for home values remain positive over the next several years. And even though the market does feel a little slow right now, forecasters still expect steady growth more long term. Inventory is still a major issue, and you may be seeing this in the market yourself. New reports show that there are fewer homes for sale today than in a normal pre-pandemic market, and that's especially true here in California, where some areas still have far fewer listings than other parts of the country. And this lack of supply does continue to support home values, even with higher rates. That's great for current homeowners. On the Federal Reserve side, some Fed members are still worried about inflation, and they're downplaying weakness in the job market. Although Powell did say the labor market's weaker than numbers have shown in the press conference after the Fed meeting this week. Others, as far as Fed members, are clearly more concerned about jobs and do see the economy slowing. Consumer spending also showed signs of slowing. Retail sales barely moved, and spending outside of essentials was flat. And that just tells us that households are getting a little more cautious, which usually helps inflation cool down and does also support lower mortgage rates, at least over time. And earlier in the week, the Fed did again cut short-term interest rates and acknowledge that the job market is weaker than official reports have shown, like I mentioned earlier. But there's been a lot of misinformation about their announcement that they're going to be, start buying T-bills. This is not quantitative easing, and I'm happy to explain the difference so you can educate your clients. Next week is going to be very important. We're getting delayed jobs numbers from the BLS, and we'll also get 2 months of CPI inflation reports as well. So hope for higher unemployment and lower inflation if you want to see mortgage rates come down. But those numbers will give us some more clarity on where rates are going to head next, and I'll break it all down next Friday. If you're thinking about buying, refinancing, or just want help planning your next move, reach out anytime. Have a great weekend.